Welcome once again. This is Pinnacle Professional College, bringing you a lecture on strategic case study. If you haven't subscribed to the channel, please do so. Just go to our channel and subscribe to the YouTube channel. Just hit the subscribe button and hit the bell icon so that anytime I post a video, you'll be notified. You can also follow us on social media on Facebook and Instagram. Now let's move into today's objectives. Today we'll be talking about e-business and e-commerce. Since it's one of the hot topics these days, especially in this whole COVID era, a lot of things are done electronically and virtually. Then we'll be talking about risk and risk management, and then we'll move on to financial management. So let's start with e-business. Now, e-commerce is simply, when we talk about e-commerce, commerce is business, and the E stands for electronic. So it's electronic business in simple terms. That's what it means. E-commerce can be defined as all electronically mediated information exchanges between an organization and its external stakeholders. So that's what we mean by e-commerce, all electronically mediated information exchanges between an organization and its external stakeholders. E-commerce could either be sell-side or buy-side. Could be sell-side or buy-side. E-commerce is sell-side if it is between an organization and its customers. It is buy-side if it's between an organization and its suppliers. So you have buy-side e-commerce and sell-side. Sell-side e-commerce is between an organization and its customers, and buy-side e-commerce is between an organization and its suppliers. E-business, which is quite similar to e-commerce, includes all aspects of e-commerce, but also includes workflows and movements of information within an entity. For example, between departments or even functions. So when we talk about e-business, we are looking at it in terms of the workflow or the movement of information between departments or function. That's why we say e-business. So it's looking at a business in terms of the departments and the functions that exist therein. Internal processes are driven by e-business methods as well as external relationships with customers, suppliers, and other external stakeholders. So what's the difference between e-commerce and e-business, right? E-commerce is looking at the exchange, the information exchange between an organization and its external stakeholders. E-business includes all aspects of e-commerce, but also adds information flow between departments or functions within an entity. So that's the difference. One is looking at organization and its external stakeholders solely. Another is looking at what happens externally as well as internally within the entity, and specifically pointing to departments and functions within the entity. So that's the difference. E-business and its implication for business strategy. E-business can change the nature of the marketplace in which goods and services are bought and sold. For example, it encourages the globalization of markets, right? And the business and selling of items in the internet. Very, very important. E-business can change the nature of the market, right? And it can influence business strategy, because things like e-business and e-commerce, they make the world a level playing field, and so it encourages globalization of markets. So someone in India can sell to someone in Azerbaijan. E-business also changes the nature of relationships with suppliers and customers. So the impact on business strategy is twofold. It encourages globalized markets and also changes the nature of relationships with suppliers and customers. Very, very important. E-commerce has been a major factor in the globalization of business. It has been a huge, huge factor. The internet and email in particular have made it much easier for suppliers to make contact with customers. in geographically distant countries. So today, because of the internet, it's easy to make contact with your suppliers and customers through email or through the internet. It's quite easy. The internet and email has also made it for customers to search for supplies in other countries of the world. So today, someone can sit in the US and source for goods in China because of the internet, because of e-commerce. So the internet and email have made it easier. Suppliers and customers can communicate with each other as well more quickly in spite of differences in time zone. What are the implications of globalization of markets? What are the implications? An important implication of the globalization of markets is that the size of the market increases, but competition is more international. So what happens is when markets become globalized, the size of the market increase. So somebody sitting in a country, somewhere in West Africa, because of globalized markets, is able to sell in other countries and in other continents. And so the market increases, but the competition becomes more international. The main rivals are no longer local suppliers to a domestic market, but international or global companies. So because of this globalized market concept, your competitors do not only become local people, right? Your rivals do not become local entities, but international entities. So you are competing on a global scale. That's very, very important to understand. Efficiency in global markets depend on information and communication. Efficiency in global markets depend on information and communication. That's what makes global markets efficient, information and communication. Companies may need to become international or global in order to compete successfully. And this means having to establish operations in other countries of the world. Because of the globalization of markets, you have companies, establishing subsidiaries in other parts of the world. What are the benefits and barriers of e-business? There are several reasons or several benefits. Number one is reduction in overheads and operating costs, right? So because communication and a lot of things are done largely on the internet, there's a heavy reduction in operating costs or in overheads. Very key. Another benefit is that it increases the capability and scope of business, for example, by circumventing barriers to entry to a new geographical market. So it increases the scope of business, right? It increases the scope of business. Today, you can, through the internet, you can sell in another country, so you're able to circumvent barriers to entry to a new geographical market. So someone sitting in Nigeria or in South Africa can sell to someone in Japan, through the internet. Another benefit is that it's improved customer service because of the speed. Another one is improved visibility through websites and other promotional activity. So internet-focused marketing through the use of marketing videos and social media tools. Today, there are a lot of social media handles from TikTok to Instagram. All these things help your business to go viral for people to get to know your business. And they serve as promotional tools or promotional platforms. Another benefit of e-business is that it reduces paperwork. A lot of things that you have to use paper. E-business reduces paperwork, and that's very, very good. That's very, very important. The next one is improve workforce flexibility, for example, by supporting remote working. So e-business and virtual working or virtual environment or virtual working or remote working go hand in hand. So e-business improves workforce flexibility. So people can sit, in another part of the world and be working. That's the whole concept of remote working, because you can work, two people or different people in different parts of the world, in different continents, can work together through the power of the internet. Enhance control of the supply chain and customer experience. Enhance control of the supply chain and customer experience. So one thing e-business has done is to improve communication lines between organization and suppliers, as well as customers, which we already talked about. And so that's what we are talking about here. And so e-business to also give some form of competitive advantage overall. What are the barriers? The barriers are, there are some little setup costs. They are not huge though, but sometimes for a very small company, it might be expensive to establish a website. These days, websites are becoming cheaper and cheaper. And so this is not too much of a barrier these days. The type of business, that's the next barrier. Some products and services are easier to sell on the internet than others. There are some products that are easier to sell on the internet. For example, computer firms sell products very successfully over the internet, as their products can be perfectly specified in writing. So some products, it's quite difficult to sell them. Some products are easier to sell on the internet. So if you are having a product that sometimes can be difficult to sell on the internet, then it becomes a barrier. These days, the internet is becoming very globalized, and so a lot of products are on the internet. Then you have ongoing operating costs. The website has to be updated frequently. If you have an internet platform, you have to update it frequently. You have to keep it interesting. You have to keep it lively to engage your customers. And another barrier is the time it takes to establish the system. So it takes time to establish a website that our customers will want to know and visit. Very, very important. Very, very important. So these are some of the barriers to e-business. As the world is becoming more and more globalized, some of these barriers are weakening and are lessening. So for instance, the cost of establishing a website is, going down, it's decreasing. And so a lot of companies are establishing their businesses online. Now let's move on to risk and risk management. Now, what is risk? What is risk? Risk is usually associated with the possibility that something might go wrong. It's the possibility that something might go wrong, that something might turn worse, or something bad might happen. That's the usual definition, but risk has a broader meaning. Risk exists when a future outcome or future events cannot be predicted. When a future outcome or future event cannot be predicted with certainty, then we say risk exists. So let me read the definition. Risk exists when a future outcome or future event cannot be predicted with certainty. And a range of different possible outcomes or events might occur. So when you cannot predict something with certainty, there's usually risk inherent in that thing. So that's what we mean by risk. Now let's talk about risk management. Risk management is the process of basically managing the downside. It's basically managing the downside of business risk, the process of managing both downside risk and business risk. And this is the term, this is how to explain risk management. Risk management is a whole culture. It's a culture. If you go into an organization that has risk management procedures in place, you see that it is embedded in their culture. So risk management can be defined as the culture, processes, and structures that are focused on achieving possible opportunities, yet at the same time control unwanted results. So basically here you are trying to manage risk, manage the level of risk. What you should know is that risk management is a corporate governance issue. Risk management is a corporate governance issue. The board of directors have a responsibility to safeguard the assets of the company and to protect the investment of shareholders. So risk management is a corporate governance issue. The board should therefore keep strategic risk within the limits that the shareholders would expect. So when we say corporate governance, it's basically how the entity is administered, or how the entity is run, or how the business is run. So you cannot run a business without risk management, because people have invested their money. The company has assets that must be protected, and so there has to be risk management measures put in place. The Cadbury Report 1992 describes risk management as the process by which executive management under board supervision identifies the risk arising from business and establishes the priorities for control and particular objectives. So very, very important. The Cadbury Report is trying to explain risk management, and you cannot manage risk without identifying risk. So the Cadbury Report is telling us that the process of risk management begins with the identification of risk. When you identify risk, then you're able to plan, how to manage it. Very, very important. The Ghana Code of Best Practices for Corporate Governance states that the duties of the board shall include, among others, the identification of risk. You see, we are told here again, and the implementation of systems to manage the risk. So when you identify the risk, you're able to implement systems to manage it. The board is generally responsible for defining the company's risk policy. So that's the responsibility of the board. And the risk appetite of the company, the risk limits, as well as ensuring that these are integrated into the day-to-day operations of the business. So that's risk management in a nutshell. That's risk management in a nutshell. Now let's talk a little bit about elements, when it comes to risk management. There should be a culture of risk awareness within the company. Every company, when you go to, ideally, there should be a culture of risk awareness. Managers and employees should understand the risk appetite of the company. So the company are in, what is the risk appetite? And that excessive risk are not justified in the search for higher profits. So in your pursuit of profits, you should not take overly excessive risk, just to make very, very high profits. You should define your risk appetite. Define your risk appetite. There should be a system and processes for identifying, assessing, and measuring risk. There should be a system for identifying, assessing, and measuring risk. When risk have been measured, they can be prioritized. Whatever cannot be measured cannot be prioritized. And measures for controlling or containing the risk can be made. So once you're able to measure the risk, you're able to prioritize it and say, okay, this is a risk that has a high frequency and a high impact, and so we would focus on it a lot more. There should be an efficient system of communicating information about risk and risk management to managers and the board of directors. So risk issues should constantly be communicated to managers and board of directors. Very, very important. And issues relating to risk must not just be left, they must be monitored. They must be monitored so that the company is not taken off guard. Very, very important. The company is not taken off guard. Now let's talk about organizing for risk management. The responsibilities for risk management and management structure to go with it vary between organizations, So the responsibilities for risk management and management structure, it basically varies between organizations. You know, what some companies will do is that they'll employ risk management specialists. You know, they'll employ risk management specialists. Other companies too, you know, handle organization of risk management very differently. So it is useful to be aware of these differences in organization structures and responsibilities. You know, the board of directors of large companies may be expected to review the risk management system within their company on a regular basis. So the board must be on top of risk issues. They must be on top of risk issues. If there are any material weaknesses in the risk management system, you know, they must provide information to shareholders. So this is where we bring this lecture to an end. We'll be continue with another series on risk in subsequent videos. Thank you for watching this video. Kindly subscribe to this channel if you haven't, and share this with your friends, and see you in the next video. Thank you.